In 1929, Wall Street lost nearly 89% of its value. Unemployment soared past 25%. It was a disaster, born from unchecked speculation and household debt. Today, U.S. families owe over $18 trillion. Wages are stagnant, and credit card balances keep breaking records. Are we ignoring the same warning signs that triggered the Great Depression? The numbers reveal a stark truth. But is another crash inevitable, or can we break the cycle before it is too late? October 1929, the market's upward climb ended in a matter of hours. Margin debt, borrowed money used to buy stocks, stood at record highs, with investors able to control $10 of stock for every $1 they put down. When prices fell, brokers demanded repayment. Forced selling triggered more declines, and within months, Wall Street had lost nearly 90% of its value. The collapse did not stop at the trading floor. Factories cut shifts, then closed. Unemployment, once just 3%, surged above 25%. By 1933, 1 in 4 Americans was out of work. Bread lines stretched for city blocks, and families lost homes as banks called in loans. The Roaring Twenties had created the illusion of endless prosperity. Consumer credit exploded, making cars, radios, and refrigerators affordable for millions. But on borrowed money, household and business debt soared. The top 1% of Americans controlled a rising share of wealth, while most families saw little real wage growth. As fortunes grew at the top, the rest of the country depended on credit to keep up. When the crash hit, the structure that propped up the boom came apart. Margin calls forced investors to liquidate, driving stock prices even lower. Banks, exposed to bad loans and shrinking deposits, began to fail. In 3 years, more than 9,000 banks closed their doors, freezing billions in savings. Industrial output collapsed by nearly half. Government response compounded the pain. In 1930, Congress passed the Smoot-Hawley Tariff, aiming to protect American jobs by taxing imports. Instead, it triggered a global trade war. U.S. exports plunged, worsening job losses at home. The Federal Reserve tightened credit, fearing inflation, but this only deepened deflation and made debts harder to repay. In 1932, a major tax increase was enacted to balance the budget, draining more money from an already shrinking economy. Economist Irving Fisher described the process as a chain reaction. Falling prices made debts more burdensome. As borrowers defaulted, banks failed. As banks failed, credit dried up. As credit vanished, demand and jobs disappeared. Ben Bernanke, decades later, would call this the classic debt deflation spiral, a feedback loop that turned a crash into a depression. The mechanics of collapse, leverage, forced liquidation, and policy mistakes left scars that shaped economic thinking for generations. Household debt in the United States has surged past $18 trillion, reaching levels never seen before. Credit card balances alone have climbed to new highs, with millions of families carrying debt from one month to the next as interest rates rise. Student loans, auto loans, and buy now, pay later bills are stacked on top, leaving little room for error. The New York Federal Reserve reports that unsecured debt, credit cards, and personal loans has grown faster than incomes, while wage growth has barely kept up with the cost of living. For many, the numbers are not just abstract. In cities and small towns, families juggle bills, choosing between groceries, rent, and minimum payments. A single parent in Cleveland works 2 jobs, but after rent, childcare, and loan payments, the paycheck runs out before the month does. Credit cards fill the gap, but the balance keeps growing. Missed payments come with late fees and higher rates, making it harder to catch up. According to consumer sentiment surveys, confidence has slipped to multi-year lows as more households report feeling financially insecure. Student loan burdens now exceed $1.7 trillion, hitting young adults especially hard. Many delay buying homes or starting families, trapped by monthly payments that eat into their take-home pay. Buy now, pay later services, once marketed as a lifeline, have become a new source of stress for those who fall behind. The Wharton budget model projects that recent tariff increases could cut household incomes further, with a 6% hit to GDP and a 5% drop in real wages. That translates to a lifetime loss of $22,000 for a middle-income family, even before accounting for rising prices on everyday goods. The pressure is not limited to any one group. Delinquency rates are rising fastest among lower-income households, but even middle-class families are feeling the strain. As debt piles up and wages stagnate, the margin for error shrinks. The lessons of the past feel less like distant history and more like a warning. When households are stretched thin, small shocks can ripple through the entire economy. The burden is heavy and growing heavier with each passing month. Corporate America is spending more on stock buybacks than on new factories, equipment, or research. In 2024, S&P 500 companies poured over $900 billion into repurchasing their own shares, while capital expenditures lagged behind. This financial engineering rewards shareholders and executives, but leaves less cash for long-term investment and worker pay. As productivity growth slows, companies become more dependent on cheap credit to support their stock prices. Regional banks face a different kind of pressure. The collapse of Silicon Valley Bank in March 2023, followed by Signature and First Republic, revealed how quickly confidence can evaporate. These banks held large portfolios of long-term bonds and commercial real estate loans. When interest rates rose and tech clients pulled deposits, losses mounted. FDIC postmortems show that risk controls were often inadequate, and exposure to commercial real estate left balance sheets vulnerable as office values fell sharply. According to CBRE, commercial property prices dropped more than 20% since 2022, straining loan performance and forcing banks to tighten lending. For small business owners, the consequences are immediate. A bakery in Denver, reliant on a regional lender for working capital, saw its credit line frozen after the bank's losses spiked. Payroll and supply orders had to be delayed. As banks pull back, credit becomes harder to find, and local businesses struggle to stay afloat. The decisions made in boardrooms and bank offices ripple outward, turning financial stress into real-world hardship. Federal debt has climbed above $34 trillion, a sum that casts a long shadow over any future crisis response. Each year, the government now spends more just to service this debt, paying hundreds of billions of dollars in interest than it does on entire federal agencies. As interest rates rise, so do the costs. The Congressional Budget Office projects that net interest payments will surpass defense spending by the end of the decade. This burden leaves less room for emergency programs or stimulus if the economy falters. Political gridlock compounds the problem. In recent years, Congress has come close to breaching the debt ceiling several times, forcing last-minute deals that do little to address the underlying trajectory. Disagreements over spending, taxes, and entitlement reform have blocked meaningful action, even as the debt continues to grow. The result is a shrinking margin for error. In past downturns, Washington could unleash large-scale stimulus to stabilize the economy. Today, mounting obligations and partisan standoffs threaten to paralyze that response. Economists like Carmen Reinhart warn that when public debt reaches these levels, sovereign flexibility erodes. fiscal space narrows, and confidence in the government's ability to act decisively can falter. In a world where shocks spread quickly across borders and markets, the consequences of hesitation could be far-reaching. A financial shock in the United States rarely stays contained. The global economy is tightly bound by dollar-based funding chains that stretch from New York to London, Shanghai to Sao Paulo. Banks and corporations around the world rely on access to US dollars for trade, debt payments, and day-to-day operations. According to the Bank for International Settlements, cross-border exposures now total trillions, with short-term funding often arranged overnight. When stress hits American markets, the effects can ricochet across continents in days, not weeks. Swap lines and emergency lending facilities offer some protection, but the sheer scale and speed of modern financial flows mean a United States crisis can trigger liquidity shortages and market turmoil far beyond its borders. As Barry Eichengreen notes, global interconnection magnifies the risk. What starts as a domestic problem can quickly become a worldwide contagion. Deposit insurance now covers up to $250,000 per account, a firewall built from the wreckage of the 1930s. The FDIC steps in when banks fail, protecting most ordinary savers from panic withdrawals. Unemployment insurance and food assistance also act as automatic stabilizers, softening the blow for millions if jobs vanish. But these protections have limits. Coverage caps leave larger balances exposed, and delays in benefit payments can stretch families thin. For a recent college graduate carrying $50,000 in student loans, a missed paycheck means rent goes unpaid and groceries become a question mark. Even with modern guardrails, a sudden shock can push those on the edge into crisis. Today, United States household debt and federal debt both stand at historic highs, over $18 trillion and $34 trillion respectively. As leverage tightens and safety nets fray, economic stability grows more fragile. The next crisis won't wait for history's permission. The lesson? Fragility ignored is risk multiplied. Share your thoughts below.